A lot of us have heard of the global financial crisis of 2008, the bankruptcy of Lehman Brothers, the fourth largest investment bank in the US, millions of people losing their jobs, and the decades long recovery that followed. The Wall Street crash of 2008 was due to the excessive use of financial tools known as mortgage backed securities. What if I told you that before the 2008 GFC, there was another financial crisis that rocked the world? It started across the Pacific Ocean in Southeast Asia and spread all over, even up to Brazil and Russia. The Asian financial crisis was a series of currency devaluations that began in July 1997 and quickly spread all over Asia. The crisis began in Thailand, where the government, after months of intense pressure, was forced to end its currency peg with the US dollar. Once the peg was broken, there was a massive devaluation of the Thai baht, which lost more than half of its value in less than a year. The contagion then quickly spread across the whole of Southeast Asia and saw the economies of Indonesia, Philippines, Malaysia, and South Korea slide rapidly into recession. The situation became so bad that the IMF and the World Bank stepped in and announced a $118 billion financial bailout package for the affected countries. Hey there friends, welcome to Filter Coffee Finance. My name is Rahul Alvarez and today I'm going to try to break down one of the most unexpected crises in the history of modern economics. So if I were you guys, I'd grab a hot cup of coffee, lean back and enjoy the ride. This is going to be a fun one. Although widely debated to this date, the cause of the Asian financial crisis can be broken down to four key events that happened in the 1980s and the 1990s. Part A, how economic factors favored Thailand. The late 80s and early 90s were a great time to be a citizen of Thailand. Between 1985 and 1995, the country grew its exports at an annual rate of 23% each year. Add to that the fact that the country had low inflation and low labor costs, Thailand was the perfect place for companies to set up their offshore manufacturing plants. To stimulate further business, the government also reduced the import tariff on goods entering the country from 30% to 17%. All of these moves definitely helped. But undoubtedly, the biggest factor that contributed to the money flowing to Thailand was the fact that the government had pegged its currency to the US dollar. Most currencies in the world are freely floating. For example, since 1993, the value of the Indian rupee versus the US dollar has been determined based on how much demand there is internationally for either currency. That is, the value of the rupee is not fixed by the government, it is fixed by market forces. When the dollar is doing well, we tend to say that the rupee has depreciated. And when the dollar has been performing poorly, we say that the rupee appreciates. Countries of developing and sometimes even developed nations tend to peg their currency to the US dollar in order to create a stable financial system. A stable system allows importers, exporters, and investors to plan without worrying about currency moves. A pegged Thai baht is more attractive for investors because they now know that if they invest in assets in Thailand, they know exactly what the dollar value will be, even if the value of those assets did change. By pegging their currency to the dollar, the Thai government was taking care of the foreign exchange uncertainty that companies would face. All of these factors led to a perfect storm where Thai banks and other financial institutions started borrowing massive amounts of money in US dollars. Part B, the rise of Southeast Asia. On the 22nd of September 1985, Japan, the US, the UK, Germany and France signed the Plaza Accord, an agreement to depreciate the US dollar relative to the German mark and the Japanese yen. Since the beginning of 1980 to its peak in 1985, the US dollar had appreciated by over 47.9%. The strong dollar put immense pressure on the domestic manufacturing industry of the US because it made imports relatively cheaper. This caused many major companies to lobby Congress to step in. An unintended consequence of the Plaza Accord was that it made Japan increase investment in East Asia, making it less dependent on the US. Fast forward to the early 1990s, the US economy suffered a mild economic crisis which resulted in the 1991 recession. As a result, the Federal Reserve did what it does best. It lowered interest rates. The rates were lowered so low that investors began to look outside of the US in search for returns. This is when they found South Korea and other Southeast Asian nations. Due to the high rates of economic growth that these countries had been registering, and the fact that Japanese exports no longer looked that attractive, investors began flooding into countries like Thailand, Indonesia, Malaysia, and South Korea. What happens when there's just too much money available? It needs to be spent or invested. On one hand, the price of assets shot up, and on the other hand, investment in public projects skyrocketed. There was a huge overcapacity created by the export industries and not enough people to work these low-paying export jobs. Many of the real estate mega projects that came up during this period were barely used, and so the bubble was created. Part C, US recovery and higher interest rates. A lot of the money that flowed into Southeast Asia was invested for just a short period of time. But once the US had recovered and the Fed chairman Alan Greenspan announced that he would be raising interest rates in the summer of 1994, the dollar began to rapidly appreciate. Along with this, there was a sharp reduction in Thailand's export growth as well as a slowdown in Thailand's real estate market. Concerns about poor export growth and the weak economy created pressures on the baht to depreciate. However, the Thai government didn't want this to happen for the following reasons. Firstly, the stable baht had encouraged many Thai firms to borrow in dollars without hedging their foreign currency exposure. So, a depreciation of the baht would increase the value of their dollar loans. Second, a sharp depreciation of the baht could increase the cost of foreign borrowing, as investors who chose to invest in Thailand would not be getting the same kind of protection against foreign currency exposure as they were in the past. Finally, a weaker baht would tend to increase inflation and reduce the purchasing power of domestic residents. For the above reasons, the Central Bank of Thailand was forced to step in and maintain the currency peg that it had promised investors. How did it do this? Firstly, it began to buy baht with dollars in the foreign exchange market. The BOT also raised interest rates, which increased the attractiveness of the currency. This temporarily did help maintain the currency peg that it had maintained with the dollar, but trust in the BOT was shaky, and that's where the issues began. As with a lot of things in finance, perception matters. A currency is only as stable as investors perceive it to be. After the central bank stepped in and tried to maintain the currency peg, the following things happened. Firstly, the Thai government found out that their currency reserves could be quickly depleted if sentiment shifted against them. The BOT's foreign exchange reserves fell from $37.2 billion to $30.9 billion in just 6 months. Second, raising interest rates adversely affected an already weak financial sector and raised the cost of capital for existing borrowers. With the entire financial situation being set up like a house of cards, only a single misstep was required to bring the whole thing tumbling down. On the 2nd of July 1997, the Thai government was forced to announce that the Thai baht would no longer be pegged to the US dollar. As you can imagine, the end of its association with the dollar caused a huge collapse in the value of its currency. This collapse wiped out local banks in Thailand. With no dollars to pay its ballooning debt, the whole economy of Thailand came to a standstill. This got investors thinking. If the situation is this bad in Thailand, then what about the other countries in the region? The contagion effect was now everywhere. Part 4. The spread of the contagion. The regional contagion spread because of the pegged exchange rates. The Philippine peso and the Malaysian ringgit had come under pressure as soon as the baht USD peg had been broken. The Bank of Indonesia responded quickly. They enlarged the currency peg band from 8% to 12% to stop speculation. But when the pressures on the Indonesian rupiah became too strong, the currency was set to float freely, starting from August 1997. Soon, it began to depreciate significantly. By 1st January 1998, the rupiah's value had dropped by nearly 70%. As panic spread across the whole region, currencies began to collapse. Foreign exchange traders and speculators were joined by domestic firms and financial institutions seeking to escape the squeeze on their financial statements. The same thing happened with the stock markets. The markets in Indonesia, South Korea, and Thailand recorded falls of over 50%. What was the main lesson that can be learned from the 1997 financial crisis? After all, not a single Wall Street analyst saw it coming. This just highlights the fact that financial markets are inherently risky and capital flows are unstable. In Southeast Asia, these threats were overlooked, and a large chunk of the risk came from the government's own efforts to attract short-term capital. When policies fail to manage and regulate the flow of capital in and out of a country, there is no limit to the damage that international finance can cause to the economy of that country. And with that, we come to the end of this week's video. I really hope that you guys enjoyed it and found it useful. If you did, please like, subscribe, and comment below, and share this video with your friends. If you have any topics in mind that you'd like to see me cover in the future, please do let me know. I'd love to get into it. That's all for this week, folks. Until we meet again, this is FilterCoffeeFinance signing off.